Let's discuss this all further with our closing bell exchange today. Tom Lydon, editor-in-chief of ETF Trends, Victoria Fernandez from Crossmark Global Investments, and Rick Santelli at the CME, as always, all with us. Victoria, I'll start with you. Clearly, the China trade headlines are weighing on sentiment today. When we've had headlines, we've seen the market move lower. But as Sarah points out, nothing too pronounced other than the tech sector. What's your take on how much the China headlines have been weighing on the market today?
Yeah, I think that's the driver of what we're seeing today. But we also have to look at it on a broader scale and say, okay, the administration, we assume they're going to come out later this afternoon and announce the other $200 billion in tariffs. The administration really feels like they're coming from a position of strength. You had PPI last week where it showed that prices weren't really going through on a broad scale from the tariffs. They've got a NAFTA deal that is potentially coming together, so that would give them an additional source of strength. And I think they're feeling very emboldened about what they can do in regards to China. And a lot of the market reaction you're seeing on the China side, as Sarah said, with the Shanghai index down, a lot of that is coming from the domestic side in China, not necessarily from the tariffs. The credit growth issues that they're having, the shadow banking has really diminished. A lot of the issues with the private companies there. So they're having a lot of domestic issues as well. But it's definitely a headline grabbing information. And this afternoon we'll get a little bit more seeing what the tariffs do. Although analysts are saying even with this $200 billion, you're only going to get about a 0.2 percentage point effect on GDP.
So we've got the right guy to ask about market sentiment. Tom, you cover ETFs. What kind of action are we seeing into and out of certain ETFs around the trade headlines?
Yeah, absolutely. Well, one of the key things is we're having more money come into U.S. equity ETFs, U.S. fixed income ETFs, than international ETFs that we saw at the beginning of the year. One thing that Larry Kudlow said earlier is Trump is very tactical in his strategies. And if you look at, as Wilfred was pointing out earlier, we've got this big decline, but the PE is around 10 in China, 11 in emerging markets. There's some emerging market ETFs that are really, really cheap, and also you can get them for an expense ratio of 14 basis points. So if you see that this might just be a tactical move on Trump's part, that eventually their plan is to work something out, what a great buying opportunity, and we've already seen a huge amount of money come in through ETFs this year.
You think broad emerging market ETF, or do you have to be country specific at the moment?
Well, I think for the average investor, they do have a home country bias, especially as everything's been great in the U.S. Make sure you have at least some allocation overseas developed, overseas emerging markets. The iShares has an emerging growth core ETF, IEMG, that's only 14 basis points. And again, that will give you all you need from a valuation standpoint. It's really, really cheap. Now, the other areas on the fixed income side, we've seen a lot of movement away from the Barclays Ag because it's got so much treasury. So a lot of ETF money is moving to active strategies, active ETF strategies, to move away from treasuries because it's so top heavy in that area, more into areas like corporates, like high yields, like bank stocks, those types of things.
Yeah, that's a good place for Rick Santelli to weigh into the conversation. Rick, with the 10-year just hovering at 3%.
Yes, hovering at 3%. As a matter of fact, from 2s all the way out to 30s, we are highly unchanged at the moment. And if you consider we've only had about a dozen closes that have actually been 3% closes, Fridays actually didn't qualify. We all round it there, but it wasn't quite there. And that speaks volumes about treasuries. Listen, there are issues that we need to contend with. Trade is an issue. But the notion that it's all bad, there's going to be a tailwind when it gets settled, and most people trading the market seem to have that belief that it will at some point get settled. As for the rest of the landscape, there's a lot of issues that we can pull out that aren't perfect. The Journal yesterday or today pulled out some of the money hasn't been repatriated since tax cut. That's fine. I'm sure it hasn't. And I'm sure a lot of business investment hasn't occurred yet either. But these things aren't on a stopwatch. And I think everybody is just too quick to the trigger to assume just because good things haven't happened in more abundance that they're not going to happen at all. I'm still optimistic on the economy. Does that mean it's perfect? No. But trade issues, I really think that they're going to give more upside than downside by a long shot when we find out what the epilogue is.